First up, let's begin with markets. To my left is Suyash. Maheshwari. Suyash, markets opening in red once again.
Yes, Shweta. So the markets witnessed another gap down opening in this morning's trade, with Nifty opening below 19,900 levels and Sensex dropping as much as 300 points in the opening trade. Now, this was on the back of a negative handover from the US markets, where we saw a 1.5% decline in the tech-heavy Nasdaq, and the S&P 500 also fell about 1%. On the back of that, there was the Asian market shares also had a sluggish start this morning, and most of them were trading 1% to 1.5% lower. Now, since the opening market has extended losses and Nifty currently is below the 19,800 level, whereas Sensex is below the 66,500 mark. Now, according to experts, the near-term support for the Nifty will be 19,700. So unless the index is able to defend that, we won't see any sort of a bounce back, and the sentiment is expected to turn bearish. On the upside, the all-time high levels of about 20,200 levels will remain key resistance levels to watch out for. Now, shifting focus to the broader market, Shweta, the broader markets today have bucked the trend in the headliners, and both Sensex Nifty mid cap 100 and the Nifty small cap 100 were trading with marginal gains of about 0.2 to 0.3%. India VIX also saw a marginal spike of about 0.42% and was about 11.18 this morning, which is below the 12 mark, indicating that volatility is still low despite today being a weekly expiry day for the markets. Now, shifting to the sectors that were in action, most sectors were trading in the red, Shweta. It was a sea of red, as we keep mentioning. And banking stocks, financial stocks, especially the private sector banks, were under pressure this morning. Also, the IT stocks were under pressure. On the other side, the PSU banks continued their run, and they were up about 1.5% in the morning. Also, realty shares were trading marginally higher this morning, Shweta.
All right, that of course is the lowdown of how markets opened this morning. Joining us is Sudip Bandyopadhyay, Group Chairman, Inditrade Capital. Sudip, thanks very much, sir, for taking time out. I want to first perhaps begin by asking you to explain to us, are we entering a consolidation phase, a much needed consolidation phase here?
You're absolutely right. I think the word which you use, much needed consolidation. I think Indian markets have rallied quite a bit from where it was. Last one and a half months have been a little bit of roller coaster, but undoubtedly the rally was strong. There was a definite positive bias in the market, and at every dip, buying was coming. Then we broke out of that zone and we crossed 20,000, and we continued to soar above 20,000. At such elevated levels, some amount of profit booking, some amount of consolidation, I think, is par for the course. And it's a sign of a healthy market that, you know, there's some bit of consolidation is happening at the current levels. Of course, the global headwinds on global news flow contributed to the consolidation. But I would rather say that we were waiting for some trigger or the other to kind of, consolidate, correct, profit. And that's pretty much what is happening. Fundamentally, there is nothing wrong as far as Indian economy, Indian capital market is concerned. Of course, there is a concern about oil prices moving up, and that does create challenges for Indian economy and Indian companies by and large. But beyond that, I think things are looking pretty good. Monsoon finally has caught up, and probably will end up with a zero deficit kind of monsoon, which is definitely good news for Indian economy, Indian capital markets, and most of our Indian corporates as well. So I think by and large, we maintain our positive bias in the market. A consolidation like this probably is a good opportunity for long-term investors to also look at accumulating good quality stocks.
All right. A big trigger that is coming in by the way of global cues, before we go to macros, domestic cues, is the FOMC meeting. The US Feds have decided not to hike interest rates, Suyash, this time around.
Yes, Shweta. So, the Fed has maintained the key rates, for the second straight policy meet. And I mean, there are two major takeaways that we can get from the policy outcome. Now, the Fed said that it will keep interest rates higher for longer. Now, Mr. Powell indicated that there will be about 2 rate cuts heading into 2024. Now earlier they had indicated that there will be about 4 rate cuts. So that will be a major negative for the markets as investors were banking on monetary easing heading into 2024. Now the second thing is that Fed also said that it could consider hiking interest rates one more time when November rolls around. Now this is again because inflation continues to remain a pain point for the Fed, and now the problem is there was expectation that Fed may consider hiking rates, but it seemed like a distant possibility as only about 30 to 40% analysts were expecting that. Now it seems that that could be the way forward, that Fed may hike interest when November rolls around. So perhaps a negative for the market, Shweta.
All right, negative there for the markets, and the markets, of course, reacting negatively to that news. Was a rate, I think a status quo, Sudeep, it was expected, wasn't it? That is what analysts, a lot of them we've spoken to here on News9, have also said over and over again. No rate hike perhaps this time around, but near future and how inflation pans out to be, whether it comes within US Fed's comfort zone of 2%, will determine the future rate hike cycle.
Absolutely right. But look, I think as Suyash was mentioning, I think the commentary of the Fed chair and a little bit of an aggressive stance as far as rates are concerned, that did make the market a bit worried. Expectation was that the body language and the commentary will be also a little subdued. There won't be any aggression as far as interest rates are concerned. But I think the commentary of the Fed chair is what kind of rocked the market. And very clearly, I think there will be more rate hikes. And the rate reduction cycle, rate reduction probably gets pushed back a bit more than what was originally expected. That did cause the damage as far as the Nasdaq is concerned, and even other markets.
So, what's your assessment of this higher rates for longer narrative? Now, this will definitely be a negative for markets, but how do you think it will impact emerging markets, especially India?
Well, Suyash, I think the way I look at it, FIIs, FPIs have been investing in India, and they will continue to invest. Of course, there will be volatility, as is always with these kind of flows. But if you look at a slightly medium to long-term view, what is happening globally is that emerging markets, funds have started attracting a lower amount of incremental flows, and that's predominantly has got to do with what's happening in China, whereas India dedicated funds have been attracting higher incremental flows. I think this trend is going to continue, and I think if one goes to interpret this trend, it's very clear that India will continue to attract more and more money as time goes by. Yes, there is definitely a fear and a rush to withdraw funds out of China, and some of that money will definitely find their way into India. That will be some of the funds will be long term there, and some will be short term funds as well. So volatility will be there, but India will continue to attract FIIs flows as we go along in this fiscal as well as the next fiscal. That is our reading. We also believe that Indian corporate performance has improved significantly over the last 1.5 years, and that does put India in a slightly better position vis-a-vis many other emerging markets. Also, by and large, the strategy of global corporates of China plus one is helping India in manufacturing and Indian trade, and this will continue. Now, this again indirectly will work towards attracting incremental business for Indian corporates and more inflow into Indian capital markets. So, if we put all this together in the mix and keep that and weigh that along with the interest rate scenario, and interest rates may not be coming down as soon as we were expecting, I think on the balance, we believe that India will continue to attract money. And, as is very clear with India dedicated funds getting more and more incremental inflows, I think that trend will continue in spite of what is happening as far as interest rates are concerned. One last point I would like to make is that there was a lot of question marks over soft landing, and even now there are, as far as US economy is concerned. But if we look at the indicators, if we look at how the US Fed and the US economy is being managed, I think the soft landing is a distinct possibility. And if that happens, I think we need not worry about US liquidity and US flows.
Mr. Bandyopadhyay, I just have another question. Now, do you think that there is a lack of coherence between fiscal policy and monetary policy? Because at a time when Fed is struggling to, keep inflation under control, we have seen that, the fiscal spend has climbed to about 3% of the GDP. So, do you see that there is some bit of, the coherence is lacking between the fiscal and the monetary policy?
Well, that's unfortunately what you get when you have a democracy. US is also heading towards an election, and as we know, the compulsions in an election year are different as far as the political establishment and the fiscal policy is concerned. I think monetary policy has to balance that out, and that's what the Fed has been doing. I don't think we need to get too perturbed with that because US has strong checks and balances. And, as we have been reading that there may be a US government, unfortunate, but US government shut down because the allocations may not get approved. So all that confusion, all that, drama will probably get played out over the next 9 to 12 months because it's an election season and because the political tension is, equally high in US. So the Fed will have to keep doing the balancing act and trying to contain the challenges which fiscal policy poses from time to time during the next 12 months.
All right, and since we were talking about FIIs, I also want to briefly understand from you, Sudip. There is some buying interest there as far as FIIs is concerned in the past 1 month. Do you see, a larger investment coming into India in the capitals market in the near course? Because let's admit it, the interest has been subdued in the past couple of quarters. Is that going to reflect in the future as well as Indian markets remain volatile?
Well, I think if you look at a medium to long term, I think we will continue to attract FII inflows into India. There's absolutely no doubt in my mind about that. Short term, there are a lot of factors as we have been discussing, US Fed, inflation, interest rates, and also Indian corporate performances. So there are a whole lot of things which in fact influence FII decision on a short-term time frame. But there are other factors also. If you look at the recent data, which indicates a subdued FII inflow, net inflow, because a lot of old transactions which the foreign investors were sitting on are being unwound and profits are being booked. We have seen a flurry of PE exits from multiple companies. We have seen a lot of FIIs unwinding their old positions. Now, these definitely happen, and it's good for the market to happen because the overhang on the counters, because we know that sometime they are going to exit, and that's happening. But the interesting part is part of that is also being absorbed by new funds, new foreign funds, part by domestic investors. So it's an interplay of these things which will continue, and that's a very good sign for Indian capital market. But fundamentally, medium, long term, definitely a lot of incremental inflows will keep coming to India.
Okay. I also briefly want to touch on inflation, since that remains the underlying theme here in India as well as in the US. Crude prices are hovering around $96 to $97 a barrel. That, of course, will impact inflation in a big way in the US, at least to begin with.
Absolutely right. Even in India, why India is definitely, this is the one single largest item which does affect Government of India's budget. And crude at 95, 96 is definitely not a good development for Indian market, Indian capital market, and Indian economy as well. So that is a matter of concern, and we have to be cognizant of that challenge. Now, the inflation has multiple other components, and we have been struggling in India with food inflation, food price inflation. And that's one thing which needs to come down, and probably with a good monsoon and expectation of a good Rabi crop arrival, I think food inflation should start coming down. We have started seeing initial signs of food inflation coming down. And if that gets played out, probably it will get balanced out. Unfortunately, the oil prices have gone up. So we won't see a drastic reduction in overall inflation numbers, but probably it will get balanced out with food inflation coming down and oil prices going up. I think that's what the challenge is. Also, remember that in an election year, election season, oil price increase in the global markets may not and normally are not passed down the line, and the oil prices may not go up in the economy. The loss may get absorbed by the in different ratio by the marketing, producing, and distribution companies, and probably that will lead to less pressure on inflation, domestic inflation. In any case, we must remember that commodity prices overall have not moved up. So it's only the oil which is kind of a joker in the pack, which is going to create trouble. Rest of the components of WPI or CPI are and should come under control very soon.
Okay, and election year not just in the US but also in India. Karthik Malhotra joining us here in the studio. Another interesting story that we are picking up is, by the way, of India's rising exports to the US. It looks like India is beating China at it.
Yeah, so we talk about geopolitical sort of tensions across the world, and if you were to look at the battle between who exports more to the US between India and China, data over the last 4 years as compiled by BCG between 2018 to 2022, in fact, Shweta suggests that India has upped its exports to the US by as much as 44%. And the export volume has jumped up to about $23 billion. Compare this to the same time-bound period between 2018 to 2022, the exports from China to US have incidentally declined about 10%. Now, what the report also suggests, and this is something which I think should be good news for India going forward, because China got out of zero COVID only last year, 2022. End of last year, December 2022, and overall, if you look at the years preceding that, 2018 pre-pandemic to 2022, US finds it about 15% cheaper to import goods from India and just about 4% cheaper to import goods from China. So the cost of making products within the US versus exporting it either from China or India, India has an advantage of about 15% in price for US as compared to an advantage of only 4% when it comes to China. Now, which are the industries which have actually been firing? You've got machinery, heavy machinery, you've got auto components, and surprisingly, because again the data is 2018 to 2022, semiconductors. India's semiconductor exports to the US have jumped up as high as 143%, more than doubled and a half pretty much. So now I think
very surprising, given just about a year ago we thought we were unable to make semiconductors in India.
But I think what worked for India was that China in any case was shut down. So what was the option for the West, especially the US? So I think now if we look at India's scenario in 2023, with hopefully, more semiconductor units coming up, with more plants being set up by way of whatever import restrictions we are putting on IT hardware, or trying to woo investors from the US to come and set up shop here in India, I think this story is only going to get better. So my question to Sudip is, hi Sudip, good morning, nice to have you here with us. I just want to understand this data from 2018 to 22 seems fairly positive, but the India story is only just beginning to shine when it comes to manufacturing. How do you see this export story playing out vis-a-vis China?
Well, I think you picked up a very interesting statistics, and we also believe that the subtle change has started happening from the last US president's time, when Donald Trump started bringing sanctions and started bringing restrictions on Chinese imports as far as US is concerned. The message to US corporates and US business was clear that the government and the economy and the country will prefer if imports from China is reduced. And taking the cue, a lot of Indian companies started getting many more orders from US corporates and US businesses than it was the case in the past. And this data you put out, I didn't know about it. I think it's a fantastic point that we are 15% cheaper vis-a-vis similar imports from China as far as US companies and US economy is concerned, and that's very clear economic logic for them coming to India. The challenges in India, where I think created by ourselves, the regulations, the bureaucracy, the red tape, and whole lot of other issues. But fortunately, those are being addressed and those are being taken care of in the recent past, and that does create a further opportunity window for India. I'm pretty confident that India will continue to gain upper hand as far as exports into China, into US is concerned, vis-a-vis China. I think at this stage, maybe to an extent overdone, but every US corporate which was importing from China wants to move out of China or definitely create a second base, alternate base. If you look at what has happened to a US corporate, they were in Russia, they were in China. And suddenly one fine morning, Russia did something funny and the sanctions were imposed on Russia. And they had to shut business, sell business at a huge loss and exit. Now for a US CEO, which has seen that this Russia episode getting played out in the last 12 months or 24 months, for him to continue with an only supply base being China, I think is an impossibility. And
Absolutely.
they definitely will need to diversify out of China.
Right. So I just want to bring your attention also to this new spice route that India and the West is all very bullish on, the IMEC, India, Middle East, Europe corridor. How do you see the trade balance really shifting in favor of India as this new IMEC comes very much in competition to China's Belt and Road Initiative?
Well, I think it's a good initiative, I will say, but I will be very cautious here. China's Belt and Road Initiative led to a lot of challenges as far as China is concerned, and they earned a lot of, for lack of better word, bad will instead of goodwill out of this project across the world. That may not be only because of the Belt and Road, but combined Belt and Road Initiative along with their geopolitical activities did a lot of damage as far as China is concerned. And I think it was not a very successful venture as far as Chinese government and Chinese industry is concerned. Some of the projects which I understand were a disaster even for Chinese corporates which went in and lent money to. We have to be careful. The economics of the entire thing needs to be very carefully worked out before Indian corporates and Indian government ventures out into that. As a concept, I think it's a great concept. It's a counterbalance to the Belt and Road Initiative. And with the world supporting, particularly US and UK and many other powers supporting this initiative of India, I think it's got a better chance of success, provided it's done realistically, provided it's done without any geopolitical tensions, and financially it is ensured that there are no major hit to either the countries over which this route is going, or the mover of the initiative, which is India. Because if it's that is the case, then long run it doesn't survive.
Now, Mr. Bandyopadhyay, I just want to bring back the conversation to the PSU banks. Now, PSU banks have been on a bit of a bull run since the start of the financial year, and like sifting through the data, it seems that the smaller banks are currently trading at a higher price to book multiples than some of the prominent names like let's say a Bank of Baroda or an SBI. So I have two questions here. First, why is that the case? And second, that do you expect these bigger banks to play a catch-up rally from here on?
Well, I've been bullish on State Bank and Bank of Baroda for last 1.5 to 2 years, and I've been recommending investors to get into these stocks. And even now, I maintain my view. Even now, for a long-term investor's point of view, buying into SBI and Bank of Baroda is a good idea. As far as some of the other banks are concerned, while a lot is being said and talked about, I would say that if you look at, let's say their historic highs. Now, a bank like Canada Bank is nowhere near its historic high. And it's a large bank as well. Now, there has been a lot of challenges and fundamental issues as far as PSU banks are concerned. The governance, the efficiency, the profit performance, the asset quality issues, all those have been major challenges. And I think there is a confluence of positive factors at this stage, which is taking up the PSU banks and even the smaller PSU banks. State Bank of India, Bank of Baroda are definitely good banks and they can compete with many private sector banks. But some of the other banks, like a Canada Bank, like a some other banks, I think they are also in a very, very good wicket. And I don't believe that their valuations are stretched as far as some of these banks are concerned. But one has to be careful, of course. Two reasons. One is, there is an euphoria. Prices have moved up too much, and some consolidation at some stage is welcome and should happen. The second is, the balance sheets, though looking repaired, there are a lot of assets which still may give them trouble in the near future. And also some of the lending which is happening now, when there is an euphoria overall in the economy, turns out to be a bit of a challenge when tide turns. So one has to be extremely careful as far as some of the smaller PSU banks are concerned. I'm not saying the rally is overdone, but a pause may be warranted.
All right, a pause may be warranted. Sudip Bandyopadhyay, absolute pleasure, sir, listening to you. Thank you so much for taking time out. We look forward to having you back on News9.